Welcome to Synthetic Alpha AI, where artificial intelligence meets institutional trading. Let's decode the market.
Disclaimer: educational purposes only, not financial advice. Trading forex, CFDs, and synthetic indices involves high risk. Past performance doesn't guarantee future results.
Every candlestick on your chart is trying to tell you something. Most traders never learn to listen. They see red and green shapes, and they guess. They see a big candle and assume momentum. They see a small candle and assume nothing is happening. But candlesticks were never meant to be guessed. They were built to be read. And by the end of this video, you'll understand the exact same visual language that institutional traders have used for over a century, including the one pattern even experienced traders often misinterpret: the mistake that quietly wrecks entire strategies. Stick around, because that one comes last.
Let's start with the basics, but not the boring kind. A candlestick isn't just a bar on a chart. It's a snapshot of a battle between buyers and sellers, fought over a fixed window of time. Every candle has 4 pieces of information: the open, the close, the high, the low. The body shows you where price opened and where it closed. The wicks, sometimes called shadows, show you the extremes: the highest point buyers reached, the lowest point sellers pushed. Here's what most beginners miss. The body tells you who won. The wicks tell you how hard the fight was. A candle with a huge body and tiny wicks? One side dominated from start to finish. A candle with a small body and long wicks? A war happened, and the outcome was close. Once you start seeing candles this way, you stop asking, is this bullish or bearish? You start asking, who's losing control right now?
Let's talk about the patterns traders actually rely on, starting with reversal signals. The hammer: small body near the top of the candle, long wick stretching downward. This forms after a decline. Sellers pushed price down hard, but by the close, buyers had fought their way back. It doesn't guarantee a reversal, but it shows a shift in control that many traders watch closely for confirmation. Now flip it upside down and you get the shooting star. The same story, told after an uptrend, with buyers losing their grip.
Next, one of the most talked about patterns in trading: the engulfing candle. This happens when one candle's body completely swallows the previous candle's body. A bullish engulfing candle after a downtrend suggests buyers overwhelmed the previous selling pressure entirely. A bearish engulfing candle after an uptrend suggests the opposite. But here's what most tutorials leave out: size matters. Context matters. Where this pattern forms on the chart matters more than the shape itself. An engulfing candle in the middle of a random sideways range means almost nothing. The same candle at a key support or resistance level, that's a completely different story.
Then there's the pattern people love to misuse: the doji. Open and close almost identical. The candle looks like a plus sign or a cross. A doji represents indecision. Neither buyers nor sellers could take control. Beginners treat every doji like a guaranteed reversal signal. It isn't. A doji after a strong trend can signal exhaustion. A doji in a choppy, directionless market usually signals more chop. Context always outranks the shape.
Now let's talk about multi-candle formations, because single candles rarely tell the full story. The morning star, a 3-candle pattern. A long bearish candle, a small indecisive candle, then a strong bullish candle closing well into the first candle's body. This sequence often reflects a shift from selling pressure to hesitation to buying strength. The evening star is the mirror image, appearing after uptrends, hinting that momentum may be fading. These multi-candle patterns tend to carry more weight than single candles, simply because they show a process unfolding, not just one moment.
But here's where things become interesting. Everything you just learned, professional traders rarely use in isolation. A hammer at a random price level means very little. A hammer at a key support zone, after a strong trend with rising volume, that's a completely different signal. Candlestick patterns are not standalone predictions. They're clues. And clues only matter when they align with the bigger picture: trend direction, key levels, and market context.
Now, the mistake I promised you earlier, the one that quietly wrecks even experienced traders. It's treating candlestick patterns as guarantees instead of probabilities. No pattern, not the hammer, not the engulfing candle, not the morning star, works every single time. Markets are driven by countless traders, institutions, and algorithms reacting to endless variables. A pattern simply shifts the odds. It doesn't remove uncertainty. Traders who forget this chase every signal, ignore risk management, and eventually get punished by the market's randomness. Traders who remember this use patterns as one piece of a larger puzzle, combined with trend analysis, support and resistance, and proper risk control. That distinction is often the difference between traders who last and traders who don't.
So here's the real lesson. Candlesticks aren't magic. They're information. The traders who read them well aren't predicting the future. They're interpreting the present, one candle at a time. Next time you open a chart, don't just look for a pattern. Ask what story that candle is telling about the fight between buyers and sellers. Which pattern from this video surprised you the most? The hammer, the engulfing candle, or the doji? Let me know in the comments.
Until next time, stay patient, stay disciplined, and trade with Synthetic Alpha AI.